Hello, everyone. Welcome to this weekend's weekly study session. I'm going to start here off looking at the long-term trend model, which is still bullish. We're up about 55% since that buy signal all the way back to April of 2020. Looking at the risk model, of course, we're at a sell signal as of August 18th. You can see the general market is neutral, up, down volume negative now. New highs, new lows is still holding up positive. We do have more new highs than new lows on both the NASDAQ and the New York Stock Exchange, but stock participation is neutral. And when we look at the stock trading environment model, which measures just the individual stocks, and grades them based on how well breakouts are working and whether we're seeing violations versus confirmations. We're on condition red, which means that this is a very challenging environment and you should be extremely cautious at this time. Taking a look here at the NASDAQ, we've gotten some distribution. And as a matter of fact, since we got that initial distribution off the highs, one day off the highs, we haven't seen any accumulation whatsoever. You can see we've got some distribution and a churning day. And then, of course, on Friday, this big swell in volume, which is a distribution day, was also because of quadruple witching options expiration. So, of course, that's going to affect that volume and make it elevated. But taking a look here, the S&P 500 or the SPY, if you remember, I shorted this, of course, on the 13th. And since then, we went sideways for a couple of days. And now we recently just closed on Friday below the 50-day moving average. And this index has tested this 50-day a whole bunch of times through this year. And also going back to the beginning of this bull market, the 50-day has been a great spot for people to add to the index because it's found support there many times. But this is the one time where I'm starting to question whether we're going to be able to hold this time. And I shorted as of even before we got below the 50-day. Of course, we're up a little bit on this with a tight stop up at the highs. Now, remember, and some people have asked why I have the cash index stop as well as the ETF stop. Sometimes you'll get where the ETF will move up and it will hit the stop, but the cash index won't. So officially the S&P 500 didn't make an all-time high or a new high. So I want to make sure that the index is making a new high. And then, of course, if the index makes a new high on the cash, but the ETF doesn't, then again, it would not stop out. So you have to have both in order to hit this stop that I have placed. Now, looking at the Russell is still in this sideways consolidation, which is still looking somewhat constructive, or I mean, it looks actually pretty constructive if this right side holds up. If we can rally out of here, maybe we still need to tighten up, and that'll take some time, and stocks will develop. Who knows? Maybe this is the start of small caps leading the mega caps or the areas that have been leading, and of course, the Russell has been lagging. But bottom line is that we're getting a mixed picture, or mixed signals from these various indexes, and that's why I'd be real careful to hang my hat on any one of these indexes. Looking at whether you're looking at the Dow, you're looking at the Russell, you're looking at the SP 500 or the NYSE, the NASDAQ, the Qs, the FFTY. We look at all these different indexes, but I like to look at the stocks themselves. So one way that I do that is to look at the percentage above their respective moving averages, 50-day moving average, of course, and then the 200-day moving average, which to me is especially important because it's a longer term moving average. And what we found is that when you're well above the 200-day, and particularly if you're going into new high ground or close to new high ground, if you've got a divergence and you're seeing this below the 50% mark, meaning that there's less than 50% of stocks above their own 200-day moving average, and right now we've got only 38.59%. So there's less than 40%. That usually is a ominous sign. Now, one of two things usually happens. You'll get where the market indexes, if you will, the underlying index will play catch up, and the stocks will tell the true story, and then the indexes will roll over. Or sometimes you get what we call a stealth correction, where you'll have the market will correct, the indexes don't correct much, and then the broader market starts to improve and the indexes march higher, and then you get more participation. That's possible too. That seems like with this really long divergence here, that could be the case because you've gotten a long period of time where stocks have gotten a chance to correct, and this is really built upon itself. But again, I would be very cautious here with this low number of stocks above their 200-day moving average and being well above the 200-day moving average. That's definitely a red flag. As I pointed out before, we had this V recovery that is just went straight to the moon here as far as off the lows from the bear market low in 2020. The last time that I saw a rally like this that was this V-shaped and just went straight up was coming off of the 2009 lows. And then we suffered a 17% pullback, went back into new high ground, looked like, okay, that's it. We had a nice little correction there, only to go right back down 21%. And then even from there, it was just eked out a high and then had to come back in 11% before we were able to get this nice easy dollar environment. During that time, the S&P only went up 11%. So you had an 11% upside and had to go through three pullbacks that were up to 2 times that reward. So again, I don't know if that's going to play out. I highly doubt it'll play out exactly like that, but we certainly are correction prone at this point. We certainly could get some type of correction, at least one pullback here. So again, keeping one foot by the door here. Here's the thing, though, that I like to concentrate on, and I know we look at these indexes and we're always talking about the quote unquote market, but 90% of my work, 95% of my work on the individual stocks, and even my market opinion, and the amount of exposure that I'm putting into the market, it's all based on looking at the individual stocks. And basically, I break it down into 8 areas. Setups. Now, how many setups do I see? How many are breaking out? Am I seeing a proliferation of setups and breakouts? Are they confirming? Am I getting natural reactions? Are we getting follow through from the breakouts? Or are we getting violations and we're getting a bunch of pivot failures, base failures? How many stops are getting triggered? Are we having a lot of stops? Are we repeatedly getting stopped out? Or if stocks are working and things are breaking out and you're running up from these breakout points, are we seeing a lot of stocks that are extended, and how are they acting from those extended levels? So I base pretty much everything that I do on these 8 criteria, if you will, or these 8 readings based on individual stocks. Get good at this, and you won't have to worry about indicators and indexes, and you could just shut the indexes off your screen, and you're going to be in the bull markets, you're going to be out during the bear markets, and you'll amaze everybody at how well your timing is, and you're not even trying to time the underlying indexes. Talking about individual stocks, let's look at PAG. I want to give you a one stock here. I want to look at the setup, analyze it a bit, and then show you a precedent. Because again, people are always saying, what's different this time, or they think things have changed, or I'm doing something different. I am doing nothing different than I've been doing for 30 years. And nothing's changed in the market. I can tell you that. You take a look at a stock like PAG. The only thing that I think is missing with this setup is that we're coming from a correction. If we were coming from a nice big correction or a bear market, and a stock was breaking out of a base like this, oh boy, I mean, that's like, I'd be licking my chops here. That's just a market leader setting up. In this case, we're late stage. I don't know if this is going to fall into that same category. If you get the 3 days up and then bang, you get hit with selling. But certainly, looking at this stock setup, this is just a perfect setup. You've got a nice big base, VCP, you've got fractals where you got little patterns within patterns. Look how tight this got. This got just exceptionally tight right here, really nice and tight. If you go down here, you'll see the volume dried up, and look at that 1 day right there. You're way down in volume, and then wham, the big volume, and this little mark right there, that says that that's the largest volume in the base. So that's a great thing to see when you break out of a consolidation. You got the relative strength 93. Accelerating earnings, big earnings here in the most recent quarter. You've got sales that are accelerating here, negative to plus 15 to plus 91%. And you also see some acceleration in margins. And you got a breakout year over here. $13 is supposed to earn in 21. That's a big, big move from this recent area that we've been in, sort of caught in a range here for a couple of years, and then started breaking out in 2020. So this is really picture perfect. Now let's go back in time and take a look at something like Kenneth Cole Productions, which I bought this in 1995, it's a very similar type setup where you've got the nice big earnings, 283% in the most recent quarter, nice sales, accelerating sales, big base, a similar size base. You've got the fractals, real nice tight right side breaking out, 3 days up. The volume dynamics are almost identical, where you get the dry up and you get the 3 days, and you get that 3 day where you get the follow through. That's exactly what we want to see. We want to see follow through buying. That's an indication that you could have institutions in there as opposed to just retail money breaking the stock out and then it falling back down and not being able to have any legs because there's no real, big money in there buying. So taking a look at those two side by side, you can see, no base it's like a fingerprint. Bases, consolidations and bases are like fingerprints. You look at a fingerprint from far away, they all kind of look the same, but you get really close, none of them are exactly the same. They're all unique. Same thing with stock bases, but there are certain characteristics in there that you're going to look for, that you're going to want to see every time, and that's the VCP characteristic, tightness on the right side, volume drying up around the pivot. And this is just really, very close the way these two look. You can see here also on the weekly, you got a nice big cup with handle forming. Look at the big weekly volume. Big weekly volume. That's the fourth or fifth largest volume since this entire stage 2 uptrend. So that's great. That's a great indication that you might have some institutions in there stepping up to the plate. Same thing with Kenneth Cole. You go back, look at that nice base, beautiful. I'll zoom up here for you. Look at that nice base form, perfect VCP. Should look good on a daily and a weekly. I always consult the weekly as well as the daily. And if you see the volume here, see the nice big weekly bar breaking it out. Again, I'll point out that this came out of a correction, so or at least a consolidation, and that's the only piece that I think is missing right now. So summarizing, we're on a risk model sell signal, and we're also on condition red on the stock model. So with those two things right there, you need to be cautious. All right. And if you haven't already seen it in your individual trading and how individual stocks are acting, this is sort of the, the last straw. So we see more distribution in the market. I think we're correction prone. How much we're going to correct, I don't know. Maybe it's already over. We undercut the 50-day. But that doesn't really matter to me. It doesn't matter to me if the S&P 500 goes higher, the Dow, the NASDAQ. What matters to me, are we seeing stocks set up? Are they breaking out of consolidate bases, buyable pivot points, and are they working? Are they holding up? Is the volatility low enough that we're able to get on these stocks and not get thrown off of them? And that's where the answer has been no for a while. And we've got to wait until we see that proliferating to where we can start playing swing trades and playing for bigger moves. Up until then, we're still stuck in that shorter term trading environment or sitting on the sidelines. So again, it's highly selective now. It's still very rotational. You saw last week, we went into energy again. Alcoa started coming back to life. I mean, we just flipped back and forth between growth and cyclical and all these various types of subgroups. It's just a time to be cautious at this point. Real quick, Master Trader program is only 8 weeks away, and this is getting even more exciting. We are adding another market wizard now. We just spoke with Stan Weinstein, and he wants to participate. If you don't know who Stan Weinstein is, he's in the first Market Wizards book, and Stan is one of the reasons, or mainly instrumental in me adding the template, the trend template to my work. In 1990, I met Stan Weinstein in New York City and had lunch with him, and he talked to me about his work and his book. I had read his book, and that's where I started adding the trend template. I realized that I went back and I looked at all the stocks that made big moves and found that 98% of them were in stage 2 uptrends. So I started with his work, and then I added to it. If you want, I refined it or maybe even improved upon it and added some criteria. And that's how we have the stage 2 uptrend. So we have Tom Basso, who of course was in the second Market Wizards book. We have Larry Hite, who is a huge influence for me. I love Larry. He's a great guy, very colorful. Stan Weinstein is an incredibly colorful guy, and I love Stan too. These are all people that influenced me decades ago. Market Wizards, in the Market Wizards book. Of course, we got David Ryan, who's my co-instructor, and who's not in Market Wizards, but in Momentum Masters, Mark Ritchie, our own Mark Ritchie, who I feel is a new market wizard. I think he's a market wizard, a modern day market wizard, and of course myself. So you just have, this is an unprecedented master trader program. It's going to be amazing. So if you haven't registered, you should register. All right, so let's take a look here. I'm not finding a lot of names, and even even some of the names that we found recently, for every one that works out, there's two that don't. So again, is the reward paying for the risk? That's what you have to ask. On a batting average level, okay, are you getting enough winners to pay for the losers? And on a percentage level, your gains, your percentage gain versus your stops or versus your risk. So those are the two very important things that you have to gauge and measure. And when those are not positive, if you don't have positive ratios on those, well, then that's a risky environment, and you need to either be out or be very careful in that environment and trading small until things start working. And that's what we've seen. But I'm going to show you a few stocks here that we do have some setups that are, some are close and some are actually ready, but not many. We've really seen this diminish in the number of names. So this ACM looks like it needs to tighten up a bit, but it's forming a pretty big base here, so that looks fairly decent. DEN. Right, let's take a look at DNN, Denbury. Another one, similar type base. I would like to see this 50-day turning up here, but this looks fairly decent here, tightening up on the right side. DRI, this is a slower grower, restaurant name, also a large base, a bit volatile here within itself, but you're tightening up here on the right side, another pivot being formed. This LQDT, right, which this is actually a pretty nice base. I like this base. I like the way it's drifting down here. So I'll be looking to see if this can tighten up, go inside, and maybe buy this one. MNDY is a power play, potential power play setting up here from a low cheat. Now, you could have tried to buy this right off the lows here. Sometimes, we'll try to buy them coming right off the lows in a power play, high tight flag. But I like to look for a cheat, a low cheat, a day or two of pause. We saw that in, and let me just pull it up here, FULC, on Friday. You got that 1 day pause and then bang, right out, up 11%, over 11% on the day. We pointed this out, of course, on Friday as it was moving and setting up. So again, we'll watch MNDY. OGN is one that this is a primary base, about 29-30% in the base here, forming the right side. You may get a little low cheat here to start your position, but this looks like it needs more work. TILE, tile. Again, you see the right side here. If you can tighten up a bit, go inside, give the 50-day time to flatten out here, maybe turn up and buy that coming out. Tesla, I put on a buy stop on Friday. It did not trigger, but if you remember, I bought this here on 8:30, and really just a textbook little cheat area, came out very nice, 2 days, pulled back. You get some tennis ball action. Then you had this pullback, and of course, the way the market was acting and some of these names, I just said, what, I'm just going to break even. I don't want to let these stocks start getting their teeth into me. So I choked off some of these, and we got knocked out at break even. But look at the close. It closed right up at the high, and since then it's holding up. This looks like a natural reaction, and it's completing this big base here. You see the weekly? Look at the weekly. It came down, closed way up at the highs. So I think this one can be bought if it breaks out from here. So we're gonna have that on buy alert, of course. XLNX, a little bit sloppy, trying to tighten up over here on the right side. You had this nice gap here. Since then, it's held up. This may come out, but again, I got to be careful here with some of these. Like I said, if you got to keep them on a tight leash and be very careful. We had some breakouts last week. Something like a Copart, right? But look what happened. This is what I want to point out. Again, 3 days up, 2 days on a breakout, and then look at that. Pow, look at the volume come in. See, this is the same theme going over and over, which I pointed out for time and time again for months. If you remember, going way back in February, March, I was talking about retail buying, breaking the stocks out into institutional selling. Here's a perfect example where you come out of here, you're coming out, and then this is not Aunt Betty selling here, right? That's a lot of volume. And look at that big down move. So this is the risk, around this short-term trades. You're still only getting those, couple days up, and then you're at risk of having the stocks come in. We had PLTR also break out last week. That's held so far, but 1, 2, 3, beware on the third day here, right? RAPT, another one, came out here for a few days. Again, on that third day, SGMS, which was down about 3.5% on Friday, up 3 days, 1, 2, 3. Now coming in. This is, like I said, this is the trend that we've seen here. We saw the energy stocks last week break out. This was on a big breakout here, this TSEM, and this is actually holding up really well. So again, we'll see what happens. But usually when you get extended like this in the short term, you get some profit taken. We did see energy stocks move, something like this VNOM. Some of these were on buy alert, of course, and you could have bought here breaking out. You had one day, came out, squatted, a third day reversal recovery. Now we're up 4 out of, was it 1, 2, 3, 4 out of 5 days up. And then what else? Anything else? I guess that's about it. Yeah, and there's a few names that I have on that on my on deck list here, but not really. Let's see, DAR. Yeah, this needs to tighten up here. DDS. This is, I mean, the Dillard department stores. I didn't think I would see Dillard department stores with a 99 relative strength, but this is tightening up here. If this could break out, you might get a trade out of this, and this might be a momentum trade because it's got that high RS. Something like a DOCS. Another one. This is a potential power play. It looks like it needs a bit more work. It's on our polls list. FIGS, FIGS. This is building that right side. We might get a cheat area within the pivot, so we'll keep an eye on that. GBL is a bit tight here. Something like URI, which is another one where I bought. It moved up for a few days. And of course, we protected ourselves and got out of this through this volatility, but it's still holding up. It might still be something that we can buy. And then a stock like Yeti, which you see here, look at these reversals. 1, 2, 3, 4, 5, 6. It looks like right here at that 103, 103.50 level, maybe right there. It looks like that's where all the supply is. Like if you just draw a line across here and you come right across this area right here, you can see that it only traded above that level on one day. And you see how it's reversed from that level a whole bunch of times. So that's the key level that you don't want to just get above it. You want to get above it from a tight, quiet pivot. And the reason why, let's show you here. So you see how if this tightens up here and then breaks out and the volume comes way down, the reason why we want that is because that gives you an indication that this supply from this left side, this is all supply. This is telling you that there's stock there for sale. That supply has stopped coming to market. And now we form what Livermore called the line of least resistance. And you can move very fast to that line. That's why these stocks, they break out, they move very quickly through it. I know some people think it's because of manipulation and all this other garbage, but that's not the case. It's simply supply and demand dynamics. So when you learn how to ascertain this and position yourself, you put yourself in a position to get very lucky, and it's not luck, it's skill, but it's a probabilities game. Does it mean it's going to work every time? No, it works over time. Over time, you're going to have it work. The probabilities in your favor as long as you're placing those trades at the right time. So again, we'll see how this plays out. But right now, I think we got to be cautious. I think we take some of these trades that set up, but keep one foot by the door and do not get aggressive until trades are working in your own portfolio. It doesn't matter what's happening in my portfolio. It doesn't matter what's happening in someone else's portfolio or what the Dow is doing or the NASDAQ or anything else. What matters is what's happening in your trading. If your trading is going well, that's the only time that you're going to get aggressive. If it's not, you're going to get conservative. You're going to pull back. If it continues to be where you can't get any traction, you've got to take a look and say, hey, is the market acting well? Am I getting knocked out of these stocks prematurely? My stops may be too tight? Am I choking off the trade? If the market's good, well, then your selection criteria is maybe off. If your selection criteria, you go back, you kick the tires, you say, I'm doing everything right and I can't seem to make a dollar. Well, that means the market's bad, and you just got to wait. And that it's pretty much that straightforward. Those are the two moving parts, and that's all I try to analyze with my own trading. Is I look back, hey, am I making good bets? Yes, I am. I'm playing aces, but guess what? I'm getting outdrawn by a pair of twos. Well, that's not going to last forever. That's not going to last forever. So I weather the storm and I keep playing my aces. I keep playing my kings, and eventually they pay off. All right, so I'm going to run, and I'll see you tomorrow in the training room. During Q&A, I'll be in there with, of course, Mark Ritchie and Bob Weissman. And let's see what this week brings. All right. Talk to you guys later. Bye-bye.